Probabilistic Thinking.
When thinking in probabilities, the first rule is to think in base rates. Many outcomes in life already have rough probabilities. The chance of making money in the stock market, the chance of becoming very rich, the chance of winning the lottery, or even the chance of finding a perfect life partner. These probabilities are not zero, but they are also not unlimited. We must accept realistic probabilities from the beginning and adjust our expectations accordingly. Expected value. The most important concept is expected value. Expected value is calculated by multiplying each possible outcome by its probability and then adding the results. For example, if a stock has a 60% chance of gaining $10, expected value equals AID 100, U 10, 6 minus 4. The expected value is plus 2. In another scenario, if a stock has a 30% chance of gaining $50 and a 70% chance of losing $10, expected value equals 50 minus 70, 15 minus 7. Even though you lose most of the time, 70, you occasionally win big. Mathematically, in the long run, you are advantaged. Bayesian updating. Probabilities must constantly be recalculated. Like a gambler who reassesses the odds every time the cards are reshuffled. We must update our expectations whenever new information arrives. This is called Bayesian thinking. New data changes probabilities, and updated probabilities change decisions. Regression to the mean.
In the long run, extreme outcomes tend to move back toward the average.
This is called regression to the moon. Extraordinary success or failure rarely continues forever. Over time, results tend to normalize. The law of large numbers. Another important mathematical principle is the law of large numbers. Even if the probability of an event is small, as long as it is greater than 0. If you try enough times, it will eventually happen. Repeated trials make probabilities real. Pareto principle. There are also fundamental probability laws that must be understood. The first is the Pareto principle. It states that a large portion of results usually comes from a small portion of causes. Often, 80% of outcomes come from 20% of inputs. For example, a small percentage of people own most of the wealth in a country. A small number of products generate most of a company's profit. In the stock market, a small percentage of companies create most of the long-term returns. Power law. Closely related is the power law. Small events happen frequently. Large events are rare, but extremely powerful. In many systems, a small minority produces very large results, while the majority produces limited impact. Only a small number of investors achieve exceptional long-term success. Bell curve. The bell curve model shows that most values cluster around the average. While extreme values are rare, most people have average intelligence. Very high or very low intelligence levels are much less common. Zipf's law. Zipf's law helps us estimate ranked values. For example, the second largest city in a country is often about half the size of the largest city. The third largest city is about 1/3 the size of the largest. The 10th largest city may be about 1/10 the size of the largest. This pattern appears in economics, linguistics, and many natural and artificial systems. Compound interest. One of the greatest probabilistic models is compound interest. As Einstein famously said, compound interest is the 8th wonder of the world.
When investment returns are reinvested,
Small gains grow into large gains over time.
like a snowball turning into an avalanche.
Compound growth is the real secret of wealth. Think in compounding terms. All return calculations should be made with compounding in mind. Just like a gambler calculates not only the current hand, but also future hands, investors must calculate both immediate gains and long-term compounded gains. A few good bets are enough. One of the most powerful probabilistic ideas is this: you don't need to win every bet. A few very good bets can make you successful overall. An investor who buys 10 stocks may lose money on several of them. But if a few perform extremely well, the total result can still be very strong. The same is true in life. You make many decisions, but a few major decisions, such as career choice or life partner, can determine long-term success and happiness. Contrarian probability approach. One of the most interesting probabilistic models is the contrarian approach. In the past, some brokerage firms observed that many investors consistently lost money. If 70% of client decisions lost money long-term, simply taking the opposite side of those trades could produce profits, even without deep analysis. We can apply this idea ourselves. If we identify strategies that consistently lose money in the long run, such as excessive trading, relying only on technical analysis, or reacting emotionally to news, and simply avoid them. long-term success becomes much more likely. This is the foundation of probabilistic thinking,